Good evening, participants. Welcome to this program of the Quality Improvement for Engineers and Supervisors organized by Builders Association of India, Kochi chapter. And it's a great privilege for me. Today we have Engineer Bosco Thomas Chaco is along with us, and he will be introducing the FIDC contracts to us. And to formally welcome him to this participants, may I call upon his close friend and our dynamic Joint Secretary of the Builders Association of India, Cochin chapter, and the Chairman of the Youth Wing, Joseph George. Joseph George, over to you to introduce your friend. Bosco Thomas Chaco, a very reputed personal in the industry, has got great background and has got real field experiences as well as lot of knowledge in the field of what is happening in the industry in the latest. And it's a great opportunity. And I would like to thank you initially also for taking the pain and joining us today with us with the invitation of your friend Joseph George. Over to you, Joseph George.
Thank you, sir. Good evening, all. Before I introduce Bosco Thomas Chaco, close friend of mine, I would like to thank our course coordinator, Dr. Anil Joseph, who's done a wonderful job in coordinating this QIP program. Also, I'd like to mention my sincere gratitude to our chairman, Cochin Center, Sri Jolly Verghese. And regarding Bosco, he's done his graduation in civil engineering from QSAT, Cochin, and further pursued his post-graduation in advanced construction management from NICMAR, Pune. He holds a strong interest in project management, contracts management, and procurement. He's worked on various major projects in project procurement, contracts management, and project management roles through all stages of typical project cycle. He has about 11 years of hands-on experience in scope development, project procurement and management, dispute avoidance, and contracts management of large-scale infrastructure projects, and also mixed real estate projects, mixed-use real estate projects, which includes a US-based MNC Greenfield Campus Development Project in Bangalore, the Brownfield Terminal and Airfield Expansion Project, Kempagoda International Airport, that's also in Bangalore, Shell Oil and Gas New Technology Center, Bangalore, and also Chennai Nashri Road Tunnel Project in Jammu and Kashmir, India. Presently, Bosco works with Turner & Townsend as a senior project manager. He also leads internal training to staff and provides expertise on contracts management. He has participated in key claims and final settlement negotiations and administrated construction contracts of projects of large scale and importance representing the employer's interest. He's also a chartered engineer in Institution of Engineers India and chartered project management surveyor in Royal Institution of Chartered Surveyors, UK. Also, I'm delightful to announce that he was my batchmate in NICMAR, Pune. Thank you all. Over to you, Anil sir. Thank you. Sir, I'm done. Can we hand over to Bosco?
Yeah, sure. Bosco, you can start, and we are all ears to you to hear what is all about FIDC contracts.
Okay. So firstly, thank you very much for giving me this opportunity and for your kind words of introduction. Just to take you through what I have planned today, is to give you a short introduction about myself as well as the organization that I work for. Then we will... Sorry, I think Edo, your speaker is on.
Yeah, somebody's speaker is on. We will just mute it once again.
Yeah. Thank you. Yeah. Then we will move on then from there to the need for standard forms of contract, and then go on to see the FIDC Rainbow Suite of contracts and focus a little bit on the key concepts in the FIDC Red Book itself. So, well, I've been introduced sufficiently by Jojo and Anil sir. But just so that everybody else knows, I was part of the Industrial Civil Engineering branch that the Builders Association of India Cochin chapter used to conduct jointly with the Cochin University. And in a way, this is a small way of me giving back to the wonderful affiliation that we had with the Builders Association there. So Mr. S.R.S. Nair, Mr. Chakravarti, everybody was part of tutoring us and kindling the interest in contracts and project management. So I currently work with Turner & Townsend.
Bosco, can you be a bit louder? Your voice is a bit coming low. We can hear you, but then some of the participants has raised the question that the voice is not that clear. Can you?
Okay, sure.
Yeah.
Is this better?
Yeah, much better, much better.
Okay, sure. Okay, so just a short introduction to Turner & Townsend, which is the company that I work for. Turner & Townsend is a UK-based independent professional services that works in cost management, project management, and program management. And we are there in 110 offices, with 110 offices in around 45 countries. And in India, we are there in around 3 cities, predominant offices, which is Delhi, Mumbai, and Bangalore. And we are around 200 odd people, split evenly between these 3 offices. And in India, we deliver program management, project management, cost management, construction monitoring, and contract services. So I am part of the contract services team here, and I lend out my experience to the projects that that are happening in country. Yeah. So moving on then to the crux of the training today. Look at this as a very initial introduction into the different standard forms of contract and FIDC forms of contract. One of the reasons why I've selected FIDC as the standard form of contract for discussion today is because of its widespread use and acceptance within the industry, and also it's emerging as much in India, but it's more widely used in the Gulf countries and in European countries. Yeah. So to start off with, let's first understand what is a standard form of contract. So a standard form of contract is something that employs standardized, non-negotiated provisions, usually in pre-printed forms. And what are its advantages is, of course, standardization and familiarity. So which means that during the tender process, there is a familiarity within the industry itself to the commercial terms or the terms and conditions that they are signing up for. And this familiarity significantly reduces the transaction cost associated with bidding for a project itself. Also, when it comes to balancing the risks and the obligations, the contract, the FIDC form, or any standard form for that matter, is prepared through a lot of consultation with stakeholder views allotted to it. And generally, the risks are allotted to the person best suited to manage it. At least generally, that is the perception. Of course, I understand across stakeholders, the view is very different. And it is comprehensive in terms of incorporating the collective wisdom and lessons learned of all the stakeholders. And there are detailed procedures that facilitate the administration of construction projects that we would generally encounter on site. Now, FIDC is not the only publishing body of standard forms of contract. There are several organizations that have their own standard form of contract. The JCT, the NEC, these are more popular forms of contract that are used in the UK. The ACA, with its branches in in several countries across different continents, also have the standard form of contract. And of course, in country we have the CPWD, the NHAI, the Planning Commission. They have a standard concession agreement that is used for all the PPP projects, and public infrastructure companies like DMRC. Of course, our focus today is on the standard form of contract that FIDC has proposed. FIDC is, of course, a Switzerland, a Swiss-based organization, and the acronym comes from their French name, well, which I'm not too good at pronouncing, but you can read it off the screen. Yeah. Now, a quick introduction to the Rainbow Suite of Contracts. Why is it called the Rainbow Suite of Contracts? Because every different contract has a different color associated with it. So I'll just take you through this small flowchart, which is pretty good in explaining how the standard forms of contract are used. So if it's a minor construction project, the green book, the FIDC short form of contract, is what is recommended. And if the design is done by the employer, then the FIDC red book is used. This is typically an item rate contract per se. And there is also the usage of the pink book for bank funded or multinational development bank funded projects. These have been prepared in consultation with the lenders and several agencies like the ADB or the World Bank. So they have greater confidence that if a project is implemented using the FIDC forms of contract, the output, or rather their money, is spent well in meeting the objectives of the contract. If, however, the contractor is required to do the design, in that case, there are multiple options as well. Firstly, if it's a broadly a simple design and build contract, it is the yellow book that is used. And if it is intended to be a design, build, and operate contract, then the gold book is used. And if it is an EPC contract that is intended, then the silver book is used. And there are, of course, other books that are prescribed for engaging consultants or services, and also for engaging subcontracts. So if a contractor is engaged under the red book, there is a conditions of subcontract for construction that he can use to further subcontract the works to other subcontractors. Yeah. So what we'll also do is, as we finish off each slide, if there are any queries around the slide, please feel free to ask them so that we can clear the doubts there and there itself and keep moving. Yeah. So any queries, any questions, anything anybody wants to ask? Okay. So just moving on. We will, of course, focus on the FIDC Red Book today. Now, we will focus on, firstly, let us understand who are the parties that are described in the contract. So, there are essentially 4 actors in the contract. The first one being the employer. The employer, or the client, as they are colloquially called, is the person who's named as such in one of the parts of the contract. And there are roles and responsibilities for each of the actors in the contract. For the employer or the client, the roles and responsibilities are to obtain all planning permissions, to get in all the permissions required to start the works, and then, of course, to provide right of access and possession of all parts of the site. And if the contractor is unable to get certain permits or to obtain copies of laws, the employer will assist him to do that. He has to cooperate with the contractor and also comply with the contractor's EHS requirements set out. He has to demonstrate to the contractor how he is going to pay the contractor. So this is particularly important for when bigger projects are bid out, and there is participation by contractors from different countries. So to every contractor, the risk is, can the employer pay me? So FIDC Red Books takes that into consideration and requires the employer to declare to the contractor, or rather give confidence to the contractor, not just at the time of beginning the contract, but throughout the contract, as to how he will finance the project. Then another key obligation is, of course, that the employer has to provide the contractor with all site data. Site data particularly normally refers to matters of surveys, geotechnical investigations, any constraints on the usage of the site, so on and so forth. And if there is any commitment to provide employer supplied materials, for example, cement or steel, that is to be provided. And a very key obligation is, of course, to make the payments to the contractor itself. And if the employer feels that he is entitled to cost or an extension of the defects notification period, he has to notify that to the contractor. Yes. So any queries about the roles or the responsibilities of the employer in the contract? And this is not just FIDC. This is also a good rule of thumb to understand the roles that different parties play, even in day-to-day contracts that you and I would be executing works for.
Yeah, I think Bosco, we can have the presentation and we'll open the interaction. Otherwise, sure, what will happen? We have muted everyone. So if they unmute, there will be too much of disturbance and you won't be able to focus on the talk. Let's say.
Okay, no worries, no worries. Yeah. Okay. Then the second actor in the contract is the main hero, as we call it, the contractor himself. Now, the contractor is somebody who is who's prescribed in the letter of tender accepted by the employer. the roles and responsibilities of the contractor are to comply with all the permissions when he is executing the works, and then eventually to execute the works itself. This means that it is not just the final end product, it is also the adequacy, stability, and safety of all works in progress as well. The contractor is required to keep on the site all documents and drawings, and if there is any design obligations specified upon him, he's supposed to be responsible for the design obligation as well. At the end of the project, when he completes it, he is supposed to complete the handover. This would mean the O&M manuals, the as-built drawings, the trainings, whatever is required. He also has to provide the program, which is essentially the schedule, and if there are securities to be provided, so that would mean the performance security or insurances to be provided, that has to be provided. And a very key part is his cooperation and avoidance of interference with others also who may be working on the project itself. And a very key aspect, especially in the modern construction world, is the obligations towards health and safety, environment, and the security of the site itself. There is also in the FIDC 2017 version an obligation for the contractor to establish quality management and compliance verification systems, and also to provide and ensure that all temporary utilities and temporary rights of way are established for not just the contractor's personal in some cases, but also for the employer, or if he's in charge of the overall site, to everybody else. And of course, lastly, if he believes that he is entitled to extensions of time or cost, he has to notify the employer and the engineer accordingly. Okay, so this is the second actor in the contract, which is the contractor. The third actor, again, a very key role, is the engineer itself. Typically, in our day-to-day works, the engineer, the term engineer is used for people who perform two responsibilities. Firstly, the project management consultant, and secondly, the architect or the designer as well. So the engineer, in the context of the FIDC Red Book, is a combination of these two roles, the PMC as well as the architect. It means, so the definition is, of course, that it is somebody who's named in the contract. He is appointed by the employer, and for all practical purposes, the engineer is expected and deemed to act in the interest of the employer, except when he has to make a determination. Now, determination is basically to give a decision on, let's say, for example, a claim or an extension of time or payments to be made. Yeah. So in all other activities or in all of his other functions, he is supposed to represent the employer. Otherwise, he's supposed to act neutrally when making determinations. Of course, the roles and responsibilities are that he has to issue instructions to the contractor, and since this is only a single entity, the Red Book also allows the engineer to delegate responsibilities. Let's say for example, maybe it is the PMC who is the engineer. He may delegate certain responsibilities associated with design to an architect, and then that way there is a dual responsibility that merges in. And he, of course, provides the agreement or the determination on matters with regards to extension of time, claims, so on and so forth. And he also facilitates management meetings between with the contractor in a lot of ways to discuss the arrangements for work and the progress of works itself. And the fourth actor in the contract. Now, this is not this is a new addition, if I may put it that way, to the FIDC 2017 contracts. A lot of the legacy contracts do not have this actor as part of the contract. Let's say, for example, in our day-to-day contracts, maybe, for example, if there is a claim, it is only then that a dispute adjudication board is enforced, or the role of the DAB is triggered. But in the FIDC 2017 edition, the DAB, that is the Dispute Avoidance or Adjudicated Board, is appointed along, or rather within 28 days of entering into the contract, and they don't play an active role during the contract performance itself, but they play a passive role, and they advise, or rather when a matter is referred to them, they can advise both the employer and the contractor together to resolve matters amicably. Now, this particular actor is introduced in the 2017 edition of the FIDC Red Book because, or rather with a view to ensuring that there is a dispute avoidance process throughout the entire execution of a project. Yeah, so we all know how long disputes can drag, how much it constrains and sort of stretches the resources that we have. So the whole idea in the FIDC Red Book, or the concept in the FIDC Red Book, is that there is somebody who is actively trying to resolve these disputes as and when they arise. Yeah. So of course, the remuneration for the DAB is paid jointly by the employer and the contractor, and there is also a separate agreement that is executed with the DAB. The DAB can be one person or three people. That is up to the parties to decide. And there are as part of their passive role, they participate in project meetings. There are planned meetings, schedules of walkthroughs that happen with the DAB when the project is in the execution stage itself. Okay, so now let's quickly go to the parts of the contract. Now the FIDC Red Book, and this is typical of any other contract that we would encounter. The FIDC Red Book has several parts, and it defines, or rather, there is a defined priority of documents. Like in any other contract, this priority of documents is most eligible to be modified as per the requirements of the contract. But there is basically, let us just go to understanding what is there in the raw form of the contract. There is the contract agreement. Now I have some examples here. Yeah, so there is the contract agreement. Now, what is the contract agreement? The contract agreement is nothing but the first page of a contract that both the employer and the contractor would sign and say what all forms part of the contract. Yeah, so the contract agreement is, if you've seen the contract for your project, it is just the first page of the contract itself. Yeah. Then the next precedence is given to the letter of acceptance, and before that to the letter of tender. Now, if I can just explain these concepts to you. So if I remember correctly, Mr. S.R.S. Nair took a session on contracts law for this audience, and he must have explained, as he did during my college days, that the basic premise of a contract is an offer and its acceptance. So FIDC follows the same principle. During the tender, the contractor gives a letter of tender. Okay, now this can include his exclusions. This can include his terms and conditions, so on and so forth. But in against a letter of tender, there is a letter of acceptance, and this letter of acceptance under the contract law in our country has to be unconditional. So I don't know if you had come across this recent case of the Vizag port and another company where there was a conditional letter of acceptance given, and the court annulled that and held it in the contractor's favor that the acceptance of the client was not absolute against the offer that the tenderer had made. Yeah. So going back to our material here, the precedence of documents is what is the main contract that's signed, the letter of acceptance, and then the letter of tender. Okay. Now, then there are the particular conditions. Now, the particular conditions comprise of two parts. The first part is contract data. Now, let us look at what all forms part of the contract data. The contract data is essentially that information that is very particular to the project itself, which means, let's say, for example, these are in some ways commercial terms or in commercial terms or terms and conditions themselves. For example, this is an extract of what all information has to be provided that is specific to the contract. Now, why is this provided? Because the FIDC Red Book or any form of contract for that matter is just a framework, and into that framework we have to fit what is specific to the project. So let's say, for example, the defects notification period. Yeah, the Red Book provides guidance that if it's not stated, it will be 1 year. Now, if a particular client wants a greater defects notification period, this is where he would put it. This is also very easy for a contractor who is bidding for the project to just look at the contract data and know what are the key points that will affect his pricing, for example. Let's say, for example, the limitation for liability. Yeah, what is the liability limit that the contractor should price for? Then, how much performance security has to be provided? What is the payment cycle for the contractor? What is the method of measurement? What is the percentage that is to be considered for overheads and profits? So this is essentially a very summary of commercial terms or specific terms that are applicable to a project. Okay, so this has matters related to insurance.
Can you make it full screen? Sure. Can you make it full screen now? Yeah.
Okay, let me just zoom it in a little bit and then we'll go slow and steady. Yeah, if that's okay. Is this visible to everybody?
It's visible. Can you make it full screen? Now we are seeing that initial phase of the presentation. The slide is visible, but then it's not full screen.
Okay, I'm sorry. I'm sharing an Excel file. I'm not sure if you're
okay. Fine. Then it's all right. All right. Okay. Fine.
Let me just try to share this important part.
Fine. Go ahead. Go ahead.
Okay. Please let me know if you can see my screen. Can you see an Excel sheet now?
Yeah, we can see that. We can see the Excel sheet. Yeah.
Okay, thank you. Yeah. So I'm sorry, there were a few hyperlinks and maybe Zoom didn't really project it when I was showing you this. But this is the essence of contract data, or rather the information that is to be included in contract data. Yeah. So we spoke about matters like defects notification period. So this states who is the employer, who is the engineer, and then what is the time for completion or the schedule that is to be provided. How is communication supposed to happen? Is it through email? Is it and if so, to whom that communication has to be addressed to? These are very basics of a contract, and I have included this in this training so that tomorrow, if anybody on site had to send out a notice or a letter, they should know where to look and whom to send it to. So the contract data in a FIDC book is where you have to go to figure out all that information. This also has all key matters with regards to if there are any restrictions on working hours, what is the LD or delay damages as they are called within the FIDC family, how they are to be paid out, what would be the method of measurement, is it IS code or is it described separately in the bill of quantities? What is the percentage for overheads and profits if there are claims or if a new rate analysis has to be done? What is the advance payment that would be paid? What is the deductions, retention money? How frequent would the payments happen? Would it be 1 month? Would it be greater in other cases? And plant and machinery. When will the amount for plant and machinery be paid? Will it be paid when they are shipped? Will it be paid when they are delivered? So all those matters are what are covered in the contract data. Okay, so I'm just going to toggle my screen back to the presentation. Please let me know if you can see this now. Yeah, can you see the presentation?
Now we are seeing the Excel sheet itself now.
Okay, sure.
Yeah, presentation is visible.
Okay, thank you very much. Yeah, so I'll just remember to move this when I toggle screens. Yeah, so that was the particular conditions or contract data. Now, what is part B of the particular conditions? These are special provisions. Now, what are special provisions? Earlier we saw that there is a very fixed form of terms and conditions. Now, these special conditions are basically a modification to the general conditions. So let's say the special conditions say that payment would be made in 30 days. And now the client or the employer believes that he's going to make the payment in 15 days. He would make that modification in these special provisions. Then the general conditions are, of course, the standard general conditions of the book. The specification is that part of the contract that says how a work should be done in writing, or what is it that is required to be provided. The drawings also give you ideas about how the works have to be executed, and the schedules. Now, typically, the bill of quantities is covered in the schedules. Now, this may be a deviation from the standard practice that is followed in country in India, wherein the architect or the engineer will say that the bill of quantities supersedes everything else. Now, the logic that FIDC uses is that the bill of quantities is only a single line item that tells you what is the quantity of work to be executed, and how that work is to be executed is mentioned in the specifications or the drawings. So the whole idea being that you go and read the full specifications, you understand the drawings, and just put a number, or rather you don't rely on the description. In some cases, the description itself is not provided. You don't rely on that when you are putting your rate for the bill of quantities. Yeah, so this is it. And in country, a lot of modifications that happen to the FIDC contract, happen around the priority of documents, because typically architects or the clients in our country are comfortable with the working practice of the bill of quantity superseding everything else. Yeah. Then, of course, if the contractor is a JV, then the JV undertaking that is required from the parties forms a part of the lower priority, and any other documents forming part of the contract. Yeah. So this could be, let's say, for example, a geotechnical investigation report, a survey report, so on and so forth. So these are the different parts of the contract. Yeah. So just a quick recap, because this is an important concept to be understood, is that there will be the contract agreement, the acceptance, or the LOI, as we call it here. There is, of course, a difference between the letter of acceptance and the letter of intent. So the letter of intent is almost like it's not fully a contract, but a letter of acceptance is a full contract in itself. So you have accepted whatever has been stated. So that's a difference. As Turner and Townsend also, we give recommendation to our clients not to use letter of intents, because there are several legal matters associated with performance under a letter of intent. Then, of course, we have the contract data, the special provisions or modifications to the general conditions, then the general conditions itself, then all the technical data associated with the project, and other key documents. Okay, so these are the parts of the contract. Now let's just try to understand the timelines and the typical sequence of events that are associated with the FIDC Red Book. Now, anybody who is working under a FIDC form of contract, whether on site, whether in the offices, whether in the bidding department, it is key for them to be aware of this terminology, because you will come across this across the entire project life cycle. Yeah. So, are you able to see my screen as well, sir? Sorry, my cursor as well.
Yes, we can see.
Okay, sure. So let us so the key. Let us start from the first step itself. Firstly, the tender documents are issued, and then there is the tender period, and there is the submission of the tender. Now, there is a concept called the base date that is defined in the FIDC Red Book. Now, this base date under the general conditions is 28 days prior to the submission of the tender. Now, what is the importance of the base date? Okay, now the base date is a very important concept for all commercial managers who are working on behalf of the contractor, because the base date essentially says this is the cutoff date on which you have to consider your prices. So let's say, for example, after the base date, there is a change in tax, or there is a change in law, because of which your rate has increased. Then it is considered that the baseline was on the base date. So if on the base date the tax was 10%, and after that, anywhere during, even if it is during the tender period, when the contract is not confirmed to you, or during the execution period, or for that matter even during the defects notification period, there is a change, then the FIDC Red Book says that you are entitled to that differential cost from the base date. So the base date is a very important concept in FIDC. And then of course there is once a tender is submitted, the contractor is provided with the letter of acceptance. Now this letter of acceptance is also a very key date, in the sense that it triggers a lot of actions. The first one being that within within a few days, 28 days in fact, the performance security has to be delivered. Then the contract has to be signed within 35 days. And once the works commence, so it is not necessary that day zero of the overall site execution or the progress has to happen along with the LOA date. That day zero can be defined later on, and that is called commencement date. So the commencement date could be 30 or 45 days also after the LOA is given. Sometimes this is done, let's say for example, if there is a delay in obtaining permits, or there is a delay in obtaining site access. So the commencement date is structured in a way that it can be flexible. Now, after the commencement date, there is of course the duration for executing the works or performing the project. And this chart of course assumes that there will be a delay by the contractor, and that the completion date will occur once the tests on completion are completed. Okay, so commencement date, your time for completion, and date for completion. So this is essentially the different terminology that is used. And then there is of course the defects notification period. The defects notification period is essentially like the DLP period, the terminology that we use here. And only defects that are notified during this defects notification period are to be actioned by the contractor. And now, if there is a delay in remedying the defects, then accordingly the release of the performance security, or there is a certificate called performance certificate that is issued, that gets delayed, right? So as soon as all the defects are remedied by the contractor or whoever is responsible for that, that is when the performance certificate is issued. And within 21 days of the issuance of the performance certificate, the performance security is returned. Okay, so this is the general sequence of events that happens as is envisaged in a FIDC contract. This will also be largely similar for any other contract that we would be executing in country. Maybe the difference there is that the performance security is provided, or rather returned to a contractor much earlier, and some portion of it is only retained for the defects notification period. Yeah, but essentially this is the overall timeline. And this is where a lot of the balance that comes into the FIDC contract, in a way that it allows the contractor significant amount of time, to price his bid correctly. We are all part of the industry here, and we know how everything happens in 1 week, 2 weeks. But here there is a significant period of time that is given for the contractor to ascertain the actual costs from the market and to build that into his pricing. Okay. Now this is the typical sequence of events. Now we will go from there to a very key principle that is there in the FIDC Red Book. This is the extension of time principle. So this is an extension of what we saw earlier from the previous slide. The commencement date, and then there is the original time for completion. So at the end of the time for completion, sorry, we'll just go to those red boxes in a short time, is the first or the original date for taking over the certificate or to issuing the taking over certificate. Now let us assume, and also of course, this date then is when the LD starts being levied on the contractor. So this is the baseline of the contract. There is a commencement date, which is a start date. There is a time for completion, and at the end of the time for completion, the taking over certificate is issued, and this is essentially the day when the LD damages start. Now let us take a scenario wherein there are certain delays that entitle the contractor to an extension of time. That means that the reason for these green color boxes of delays are the employer's responsibility. Let us also assume that the contractor, for no fault of the employer, has also caused delay to the work, and that just for the purposes of explaining this concept is greater than the employer's delays. So contractor's delays in orange, employer's delays in green. Assume in this use case that there is a difference between the contractor's or rather the contractor's delays are greater than the employer's delays. Then what happens is, as per the principle in FIDC, and this is a good thing for everybody to understand, is that firstly, whatever delays were attributable to the client, they get added and the contractor is given additional time. Okay, so which means that there is now a revised time for completion, which also means that your date for issuance of the taking over certificate changes, and there is a revised date for commencing the delay damages. So what was previously here, your LD will now start only after such duration for which the employer was responsible. Okay. So even if the contractor was responsible for delays during that time, if because the employer was responsible for part of those delays, FIDC Redbook gives you that extension of time in a way that your LD start date then changes. But nevertheless, you still a contractor would still have to pay the LD amount for the delta duration, or for the duration where the delay is attributed to the contractor and not to the employer. And it is only at the completion of those works, whenever the work is completed, that the taking over certificate is issued. So the original taking over certificate, which was issued here, gets issued after the works are completed. Okay, so this is it. I'll just go through this entirely once again, and just focus a little bit maybe also on the red boxes now that they come in. So there is, of course, the commencement date and the original time for completion. There is the principle in FIDC that even if there is a delay, the employer is not entitled to profits. So he's not allowed to benefit out of the contractor's misery per se. There is also a more detailed concept of concurrent delays, which the FIDC Redbook allows an employer, or rather the engineer, to determine himself. But again, just sticking to the basic principle, there is of course the original date for issuing the taking over certificate. This is the date originally when the LD starts. If there is a delay because of the employer, which is lesser than the delay because of the contractor, then the time for completion gets added, and the LD date changes to that time for which the employer was responsible. But the LD would still be applicable for the delta period of time that exceeded, and the taking over certificate is anyways issued after the works are completed. Okay, so this is the concept of extension of time and application of LD within the FIDC Redbook. Okay, so just moving on, we will now go through the payments and valuation principles that are there in the FIDC Redbook. So this is again a chart that is there. All RA bills, which is called interim payments within the FIDC Redbook terminology. The timeline for that is that whenever a monthly bill is submitted, and it is the responsibility of the contractor to submit it along with a statement and supporting documents, within 28 days, the engineer is supposed to issue an interim payment certificate. Okay, so he doesn't necessarily have to certify it, but he can say, okay, if 100 rupees is claimed, he agrees with 80 rupees of that. Now, even if the engineer does not give this, the contractor will be paid from the day he submitted his RA bill within 56 days. Okay, and if the employer doesn't receive it, yeah, if the employer doesn't receive a payment certificate from the engineer, he has to pay in full. Otherwise, he pays whatever the engineer has issued, the amount that is stated in his interim payment certificate. Okay, so 28 days essentially for verification, but irrespective whether that happens or not, he gets paid on the 56th day. Now, when it comes to the final payment, the concept is a little different. There is first supposed to be an interactive or rather consultation between the engineer and the contractor about the final bill, and then the contractor submits the final statement and discharge. The discharge is essentially a certificate which says that he's done all the works and he has no other claim to the employer. Now, within 28 days, the engineer issues the certificate, or the engineer is required to issue the final certificate. And 56 days after that, the employer makes payment. So for the final payment, the payment cycle to the contractor is 28 plus 56, as against an interim payment wherein it is flat 56. Okay, so this is essentially the difference in payment concepts. But just moving on, for advance payments, we saw about interim payments and the final payments, but in terms of advance, the amount that is to be paid as advance is stated in the contract data. That's something that we saw. Now, in order to receive an advance, there is a precondition, which is the submission of the performance security and the guarantee for the advance payment. And per FIDC, wherever an interim payment or an RA bill is greater than 10%, 25% of that RA bill is the recovery to the advance payment happens at that rate, and the recovery has to be completed before the completion of the works, or if there is a termination event or exceptional event, which is essentially another terminology for force majeure. So the advance has to be paid, has to be recovered before all these matters. Yeah. And there are also certain requirements from the contractor, which is to give a schedule of payments. The schedule of payments is essentially a short indication to the employer to let him know how the payments will happen, so that the employer can plan his cash flow accordingly. And if there are any advances towards the plant and machinery, then they have to be stated explicitly in the contract data itself. Now, there is also a provision within the FIDC that allows, or rather that entitles the contractor to if there is a delay on behalf of the employer to make the payment, then the contractor is supposed to receive financing charges at what was the bank PLR plus 3%. Yeah. So this is a lot like our home loans. If you've taken a home loan, there will be a fixed rate and there will be the 3% markup on that rate. So this is about how payments, the life cycle of payments itself. There is, of course, a very elaborate session on how the works are to be valued or rather measured. But it is very typical of our day-to-day practice that joint measurements are undertaken. And once the measurement is agreed, then under the FIDC Red Book, like I said earlier, it was the FIDC Red Book is an item rate contract general conditions. So to the measurement that is agreed, the appropriate rate or price is applied. And there is also a framework that is defined for items where there are the rate is not defined, for NT items essentially. So which says that now it is not just for NT items, even for items if there is a change in quantity, a rate change is allowed. Now, there are, of course, a few preconditions for allowing rate change if there is a change in quantity. The first one is that, of course, the change in quantity is greater than 10% from that in the contract. And there is also, FIDC have specified this condition that that rate change or the change in quantity significantly, or rather affects at least the scale of that works itself. So only if the change in quantity and the to the rate makes a significant impact to the contractor, only then a new rate is provided. And there are also certain items called fixed rate items for which the change in quantity does not apply. Yeah. So, but essentially, if there is a change in quantity greater than 10% and that change is significant enough, that significant enough is quantified by the change in quantity and the specified rate being greater than 0.01% of the original contract price. And also if the change in quantity directly changes the cost per unit by more than 1%. So if you see, all these are and conditions. Yeah? These are not or conditions. So firstly, there has to be a significant change in quantity. Secondly, that change in quantity, or rather the change in price now should significantly impact the accepted contract amount. And also that the change in quantity directly changes the unit cost of that item by more than 1%. In that case, a new rate is applied. Or alternately, if the work is a variation and there is no rate specified in the variation, or if the if the item isn't similar to anything else, then also a new rate can be derived based on relevant prices or as per the reasonable cost of execution and reasonable profit. Now, till the time a new rate is agreed or determined, the contractor still requires payment, and FIDC facilitates this by telling that an interim or a provisional rate has to be determined by the engineer till the time the final rate is finalized. And this is mostly to do with the process of claim itself. That any request for a new rate has to follow a process of notification, agreement, or determination by firstly the contractor has to notify the engineer, and then the engineer has to determine. Now, there are also cases when there is scope that is removed from a particular contract. Yeah, and FIDC also allows or rather defines a framework for this. Now you can read it out here, but let me just put it to you in a simple example. Yeah, let's assume that there were certain canopy works that were to be done on a G+4 building, but let's say eventually the client decides that he doesn't want a canopy on the ground and the first floor. But when the contractor would have priced his rate for the canopy, he would have spread the mobilization cost of, let's say, a crane to fix that canopy over the overall quantity of the items. But now, because half the quantity is gone, his new rate may not be feasible. So if initially so whatever was omitted, that is the canopy on the ground and the first floor, the mobilization cost that was spread over those amounts that were omitted can now be spread over the remaining quantity of items. So that is generally the principle on omissions. So this safeguards the cost that is incurred by the contractor to do something that he had priced for, or however he had priced for it. Yeah. So that is all that I have as part of the training. I'm happy to let's just look at the time. I think we are also good on time. So I'm happy to take up any questions that you may have, or alternately, if there is if everybody is open to some more time, we can go through the index of at least the Red Book, and I'm happy to run you through the different clauses that are there. So over to you, Anil sir, however you want it. Yeah.
Yeah, very, very nice and interesting presentation, and has gone in detail and explained in detail so that everyone can follow what was it all about. Now let me open it to the audience for the interactive session. Whoever is having the questions can ask that, and if it has to be continued, that red book, then I think Bosco can go ahead with that.
Sure. And again, just if I may add, this is, I would say, just 10% of the overall red book. When I do some sessions internally for our teams here, we do that as a half day or a 3/4 day workshop. So there are a lot more concepts, there are a lot more administration principles that exist, and maybe if there is more time at a different forum or a different training session, I'm happy to take that for the yeah.
Sir, good evening, sir.
Yeah.
Yes. Good evening, sir. This is Giri.
Yeah, hello, Giri. Go on.
Yeah, there is a question. Just now, the last bit where you said, no, the crane, the part is loaded evenly for all the activities. Now, how to know that what is the percentage of amount that is loaded?
Okay, so this is actually not a FIDC concept. This is more of a claims and contract law concept. That if the contractor is making a claim, or rather for that matter, whoever makes a claim, the onus on proving that claim lies with the party who is making that claim, which means that if the employer will not know how the rate is spread, right? But if the contractor knows through, or that this is how the rate was spread, and he comes and demonstrates, it is the onus is on the contractor to demonstrate that the rate was also spread on the other items as well, and therefore he should now get this amount that he doesn't that has been omitted.
He may load more when he wants to claim. He may load more, no, sir?
He has to demonstrate that. Again, like I said, if through his demonstrations, he has to submit all the documents essentially. I mean, in short, if I had to put it, he has to make the claim, he has to demonstrate the claim, and then the engineer makes a determination. So the engineer will typically make a determination based on whatever is submitted to him. So a claim, even when it goes to arbitration, if there is any loss that is incurred, has to be demonstrated or proved before the arbitrator. So it is the same principle. Just because somebody says, okay, I did this, it doesn't necessarily hold good. You have to demonstrate the way you had earlier worked the rate analysis, and now how it becomes different. Yeah.
Thank you. Thank you.
No,
yeah, there is one question from Prashant Bhattacharya. Please
okay.
give a short intro to variation.
Okay, variations. Now that is a very big topic, but generally a variation is something that is okay. So within the FIDC book, there are a few ways in how a variation can start. Okay, so firstly, a variation can be instructed by the employer. Okay, and when by the engineer, and when he does that, he gives an instruction to the contractor that this is the variation, please start the works. Now what FIDC says is that as soon as that instruction is given, within 28 days the contractor has to submit details associated with the cost or the impact of that on the overall time for completion. And then after the contractor submits all these details and the engineer is satisfied that the details have been provided, the engineer makes a determination. So the engineer acts as the judge in the first instance. Now this is one way of doing the variation. Another way of doing the variation is that the engineer can seek a proposal from the contractor to perform a variation. So he's not instructed the variation, he's not given you a go ahead to do it. He has only sought a proposal from you to do some additional works. Now, if that proposal is accepted, then he confirms that variation to you, and then you are supposed to go ahead and prove. Now, the third instance, this is of course when the variation is initiated or rather acknowledged and initiated by the engineer or the employer. Now, the third instance arises when there is an instruction from the engineer. Okay, and this is not a variation instruction. An instruction as to how to do works is given by the engineer, and the contractor believes that it is a variation. In that case, there is a detailed claim process that is defined in the contract. So in short, the contractor has to say what is the claim, why it is a claim, and then after giving notice within a few days, he has to demonstrate the cost and time impact associated with that variation, and so on and so forth. Yeah, so this is essentially, if I can put it, in a small nutshell, this is how variations are treated under the FIDC contract.
Yeah, it's quite clear, Bhaskar. Now there is another question from Varun Srikumar. How COVID impact is interpreted in FIDC? Any amendments?
No, so there is no amendments that is required. So we saw as part of the presentation that the terminology that is used in the FIDC is exceptional event. Okay. Now, exceptional events. Okay, let me just open the FIDC book, and maybe that is a good way of taking you through that. This, in fact, this also is a very subject in very much detail, if I can put it that way. But if you give me just a second, let me just open up that clause and we can go point by point. Yeah. Okay. If I can just share my screen, please let me know when you can see my screen. Yeah,
yeah, we can. Yeah.
Okay. So an exceptional event, or rather force majeure. Okay. Now I'm not going to say this specifically about COVID, but I'm just going to explain this, and maybe I'll leave it to each of you to judge whether COVID also is an exceptional event. Okay. So just keep COVID at the back of your mind. Now, was that event beyond a party's control? So, which means that whenever the COVID occurred, could either party have controlled it? Well, the answer, you keep your answer to yourselves. Yeah. Now, could either party have provided against that before entering into the contract? So, let's say a contract that was entered into in 2019. Yeah. Could either party have provided for that particular event occurring? Okay, I mean, think about it in the context of COVID, but this is how this is like a filter of sorts. And having arisen, could the party have avoided or overcome that event? Which means, once, let's say, for example, the COVID lockdowns were done, could the party have avoided or overcome that lockdown? Think about it. Yeah. And it is also, was the COVID event because of the other party? Okay, so if the answer to all of these, is a yes, or rather, if either party could not have done it, or both parties could not have envisaged it when they entered into the contract, or once it has occurred, could either party have avoided or overcome it? They couldn't have, maybe. And was it attributable to the other party? So if the answer is no to all of this, then it is an exceptional event. Now, you can think about, does COVID fit into the definition of exceptional event? I think the answer is largely yes, and that is also the guidance that is provided by FIDC, that yes, COVID comes under the definition of exceptional event. Now, then in the contract, as we see here, it says what happens if an exceptional event happens. Yeah. So FIDC also says a force majeure or exceptional event can be A, B, C, D here. But over and above this, any event that is fulfilling these 4 criteria also is an exceptional event. Okay, so this is how COVID is treated. Of course, some contractors have chosen not to go down this route and claim relief under this clause, but instead state that it is because under FIDC, if there is an exceptional event, there is only extension of time. There is no cost associated with the extension of time that is covered. But if you want, there are some contractors who have said we want extension of time and cost, in which case they have not claimed it under exceptional event, because if you do it, then your remedy is only extension of time. They have said, in fact, that it is a change in law, and under the FIDC contract, change in law, allows or entitles the contractor to both extension of time and cost. Now, of course, again, it is the onus is on the claiming party to prove that there is a change in law. Okay, now that is another entire discussion itself, that there was already the Epidemics Act. Does a notice under the Epidemics Act constitute a change in law, and so on and so forth. So I believe, just if I think I have answered your question, but I mean, this is a very interesting topic that is up there for discussion. Yeah.
And there is one question from Saeed Haider. I am a quality engineer. How can I get benefited by the concepts of FIDC Red Book? And also one more question, can a quality engineer work as a quality cum planning engineer?
Okay, I'll try to answer the first part. The second part is entirely up to you, your interest and your skill sets. As a quality engineer, okay, let me put it this way. The contract requires you to do a particular work, right? And the contractor has signed up to do the work in that particular way. Now, as a quality engineer, you should know what is the requirement under FIDC, or rather under any contract, for you to deliver the quality. So let's say, for example, if you're doing a road, the specifications for that road, for the quality of that road, are different if you are doing a road, let's say with the PWD, to maybe if you're doing a road under the National Highways Authority. So as a quality engineer, your responsibility under the contract is to know what your contract says you have to deliver. And also specifically on quality engineering, there is a express requirement in the contract that there is a quality management plan that the contractor has to establish and demonstrate. Okay, so your duties are defined under the contract as to how you should do it, or rather, if I can put it that way, when you do it, you don't do it like you would do it on any other project. If there is a FIDC contract, you have to understand what is the requirement for quality assurance under the FIDC contract to do it. As is the case also with other contracts, but FIDC also has a specific clause on quality management plan and its adherence.
And one more question from Bruno Tayo. He says, can the employer opposes the extension of time request by the contractor?
Can he oppose? Yes.
Can the employer oppose the extension of time request by the contractor?
Okay, so this is where the independence of the engineer comes into play. Yeah. So when we saw the roles of the actors, that the engineer acts independently when he is making a determination. So let's say, for example, the engineer has studied all the documents that the contractor has provided, and he gives an extension of time of 20 days. The employer can actually challenge the decision of the engineer, and then the onus is on the engineer to justify why 20 days is an entitlement to the contractor. So yes, the employer can challenge the extension of time. Again, in that case, he has to state very clearly what are the grounds of his challenge. Yeah, like in any other arbitration or any other case, you always have to be clear what are the grounds under which you are challenging.
Sheshagiri asked this question: what FIDC books to be referred? What FIDC books to be referred?
Okay, so so if you remember the first flow chart, that kind of gives you that I'll just probably just exhibit that again, just for his benefit. Okay, so if you can see my screen, so these are the different FIDC books. Okay, and depending on your project, you have to select the particular condition of contract or the FIDC book. Now, once you have selected, let's say for example, you have selected the silver book, then during the execution of the contract, you have to keep referring to the clauses in that silver book. Yeah, okay.
Then Atul Saganathan has this question: once the conditions of contract is signed off by all parties with particular conditions of contract to FIDC standard clauses, at the time of any dispute, does the original conditions in FIDC are valid legally?
Legally, okay.
Yeah.
That last word is a little tricky there. So firstly, yeah, like in our contract or any other law, the FIDC contract or any contract for that matter has to be within the ambit of law. So if it is not complying with the overall legal framework, that clause itself becomes illegal. But if I've understood your correct, yes, this another part of your question correctly. Yes, the modifications that are made to the contract, okay, they supersede the written general conditions. Okay, so so I think that hope that answers your question.
And then there is one more question from Anand, that since the FIDC guideline seems to be heavily favoring the contractor, how has the acceptance of contracts with such guidelines been, especially in countries like India?
Okay, so you are the first person to say that the FIDC contract favors the contractor. But yeah, I mean, employers are also taking the view. And what the employers do is that, they bring in special provisions or bring modifications so that whatever is onerous to, let's say, an employer, or whatever is the practice here, that is confirmed. So for example, FIDC has a provision that we spoke earlier about variations by seeking a proposal, right? So there is of course effort that is put into making a proposal, right? So what FIDC says is that the engineer does not give you that variation after you submit the proposal. You can come and claim, the cost associated with putting together that proposal. Now, of course, in our industry, that is not really the practice. So, so let's say, for example, the employer will make a change through the particular conditions to say that even if he gives you that proposal, you will not be paid additional for that proposal. Okay, so yes, I think it is not acceptance wise. It is generally acknowledged that FIDC covers all scenarios. We saw how that COVID scenario is also covered, right? So it covers all scenarios. Now, whether you are okay with the principle of allocation of risk within that scenario or not, that is up to you to decide, and you can modify that. Okay, so just look at it like a standard template. You can modify the template to suit your works.
And Sheshagiri would like you to continue with the index of Red Book.
Okay, yeah. I think we have 10 minutes left. We'll just see if there are any other questions, and maybe we can just get on to it.
Yeah, I think so
Hello.
far.
Hello, sir.
Yeah.
Sir, this is Amjad. Sir, thank you for the wonderful class, sir. And what I want to know is, usually in some projects in Kerala, particularly in Kerala, what I have seen that employer calls for a tender from different contractors, and they get the lowest contractors, and they shortlist lowest contractors, and they call for a negotiation after getting the lowest. Is it anything mentioned about this negotiation in the FIDC? I mean, what does it mean after calling? I mean, getting the lowest rate from the contractor, again they call for a negotiation. Is it only practice in Kerala, or have you experienced it in your project?
So FIDC does not specify, or doesn't. It has very broad guidance on how a tendering should be done. Now, the specific instance that you mentioned is to do with how a commercial negotiation takes place. Now, certain clients, maybe if the lowest quote also doesn't fit in their budgets, maybe they want to have a discussion of how they can, get it to fit within their budget. But I wouldn't like to believe that is the standard practice. And at least with some of the clients that we work with, we don't always recommend them to go with the lowest. There are, just when we come to buildings, for example, somebody who uses, X type of formwork, his rate will be different from somebody who uses a B type of formwork. So, your typical cup and lock formwork has a different rate to maybe if a table formwork is used. But what does that give the employer? That gives the employer the benefit of time, right? So is he willing to pay for that time, or so L1 is not necessarily the criteria everywhere. Of course, our government and our governance practices require that in several cases L1 is selected, but that's not always the case for different types of clients, if you can put it that way.
One more question: if COVID is considered as an exceptional event, does the contractor is entitled for cost, or is it under force majeure? So I think you have already explained that.
Right. So under the FIDC contract, There are a few events of exceptional event for which cost is also payable, but otherwise, in general, where it is not specifically called out like COVID, it is only extension of time and no cost associated. Okay.
Yeah, I think whatever is the question listed, we have covered. Yeah.
Okay, so I think we have some time here.
Remaining time, I think you can go in for the guidelines.
Of course, it will not finish in 10 minutes, but broadly, I'll just show you how the index looks like, and just to give you an idea of what the clause says at least. Yeah. Okay. Please let me know when you can see my screen. Okay. Is my screen visible, sir?
Yeah, clear.
Okay, perfect. Okay, so there are 21 clauses, and this is the FIDC 2017 edition. This is the latest edition that has come. A lot of existing projects are running on FIDC 99. There is a difference in the way the clauses and provisions are arranged between FIDC 99 and FIDC 2017. That can be a topic of another training some other day, but just the FIDC 2017. The first part is a general provision. So this has definitions. This states how the contract will generally be administered, the administration processes, everything to do with who uses what documents, confidentiality, liability, and so on and so forth. Yeah, this contract termination here, just ignore this, but otherwise these are the sections that the first part covers. The next part is about the employer. What are the roles, the roles and responsibilities of the employer to provide the right of access to the site, give assistance, how he's supposed to behave on site, how he's supposed to inform the contractor about his financial arrangements, what is the information he's supposed to give, and if there is some employee supplied material, when, where, how does he give that? Yeah. Then the next part is the engineer. Who is the engineer? What are his roles and responsibilities? How can he delegate authority? Who is supposed to represent him? How his instructions have to be given? If an engineer is to be replaced, how that's to be done? How the engineer is supposed to make the agreement or the determination, and meetings, and the right of the employer to call the engineer, to call meetings. Then the section on the contractor, his responsibilities, what he's supposed to do, how he's supposed to do, if he encounters, I mean, everything, every foreseeable thing that we typically encounter, including, if there are archaeological or geological findings, how to handle them. Then the next session is about subcontracting. So how is a contractor supposed to engage subcontractors? If there are nominated subcontractors, how that will work out. So this is just the heading. There is a very detailed framework that is given. Then the staff and labor, how the contractor is supposed to engage staff and labor, how he's supposed to do it, and what are the facilities he has to provide, what is the records he has to keep, how does he, who are the people that should be there on site, as part of the key personnel. Then the plant and material and workmanship. This is who, what, how is to be provided, how it will be inspected, how it will be tested, if there is mistakes or remediation to be done, who does that, who takes ownership, when is the ownership passed on, so on and so forth. Then of course commencement, delays and suspension. So we saw earlier on the timeline that the commencement can happen significantly after the letter of award is given. So then when do works commence, what is the time for completion, what happens if it is delayed, or the requirements for giving a schedule, what happens if the program is not meeting the progress is not meeting the schedule, how will they be paid, what happens if there is a suspension, what is to be done if there is resumption, when there is resumption of work, so on and so forth. Then the tests on completion, what tests are to be done, how they are to be notified, if a test fails, what happens, and so on and so forth. Then the requirements of employees taking over. So once the works are completed, what is the process or the procedure for taking over the works, and so on and so forth. Then clause 11 is section 11, is entirely about defects after taking over. So during the defects liability period, how it is to be notified, how it is to be rectified, how it is to be tested, validated, if you have to take things off site to do the defects rectification, what is the process and procedures, so on and so forth. Article 12 is about measurement and valuation. So we went through a little bit about this, how it is to be measured, how it is to be valued, and if there are omissions, how the works will be valued. Article 13 is about variation and adjustments. This also we spoke about in some brief. How it can be varied, if there is value engineering, what is the share, what is the variation procedure, how to do provisional sums, day works, how do you make the adjustment for changes in laws, or if there is a significant escalation, how those variations and adjustments are to be made. The next part is about the contract price and payment. What are the components of the contract price? How and when the advance is to be paid? When will interim payments be made? How the interim payments have to be sought? When will retention amounts be paid? When will when will the final payment certificate be issued? How the payments will be made, the duration within which they will be made, and so on and so forth. And then, of course, termination and its consequences. Firstly, if the employer initiates. Secondly, suspension and termination by the contractor and its consequences. Section 17, Article 17 is about who takes responsibility for what, how long do they take it for, what are the matters that are covered under the different liabilities, and so on and so forth. Section 18 is about exceptional events, a lot of it that we read through now. Section 19 is about insurance, what are the insurances that have to be kept. Section 20 is a very important section. This states how, when, and the procedure associated with making a claim for either a payment or an extension of time. And clause 21 relates to disputes and arbitration. If there is a dispute, what is the process? Who has to give notice to whom? How that dispute will first be resolved? When does it go to DAB? Or if a DAB gives a decision, what happens if one party does not comply with it, and so on and so forth. Yeah. So this is essentially the index of the entire thing. There are lots of references, cross-references, and yeah, if there's another session, yeah, happy to take you through that. Of course, that's a longer session, maybe requiring little more than half a day. Yeah, entire.
And there is one more question. In value engineering, what is the ratio or percentage of saving or value addition is shared between the two parties?
So that can be defined in your contract data. If I remember off the top of my mind, it is 50-50 in the base one. But that they have put like a fill in the blank that you can fill in the blank in your contract data. So there is again, just a framework that FIDC has provided. The actual numbers, the employer and the contractor can agree to put in there.
Yeah, any more questions from the participants? So I think we are just reaching the time. I have one question regarding the Vizag port project you were talking about. Can you just enlighten us exactly what has happened and how the decision had come in?
Okay, so to the best of my knowledge and off the top of my head, so as part of the tender process, and this was for something sleeper berths or something to that effect, the bidder had given his proposal with a condition. Now the client gave the LOA or the LOI, but he said, I am not accepting your condition. So the contractor refused to do the work. So the client then went on to claim the, what do you call it? Not the retention, the earnest money deposit. Okay, so what the court, so then in order to retrieve the earnest money deposit, the contractor went to court, and the lower courts as well as the high court ruled in favor of the employer that, okay, the employer, you are right to take the earnest money deposit. But the Supreme Court ruled that that because the acceptance of the contractor's proposal was not absolute, there was no contract at all in the first place. So the employer had no right to take the earnest money deposit. And so he awarded the return of the earnest money deposit along with the interest charges. I have the case law with me, and I can pass it through Joseph to you, sir.
No, fine. I just wanted the people to understand about the impact. And now it was a very wonderful session. I would like to call upon our chairman, Jolly Varghese, for the vote of thanks. And in fact, there is a request for one more detailed session. We will plan as we move forward. Yeah.
Sure, no worries.
Chairman, please go ahead.
Good evening, Engineer Bosco Thomas.
Good evening,
See, the FIDC agreement or contract conditions and construction management is just like an ocean. But within this short time, you have explained in very detailed and very simple manner. So your presentation was very interesting and well explained. On behalf of BAI Coaching Center and all of the participants of Quality Improvement Program, I would like to extend a sincere thanks to you, sir, for spending your valuable time with us. Thank you, Engineer Bosco. And I have a doubt, as you already said, in case of a force majeure, the contractor is entitled to get the time extension. But at the same time, if the time extension means it's cost escalation also. In this particular time, due to shortage of migrant labor, see, majority of the migrant laborers were returned to their home states. Then there is a huge shortage comes in the labor force. So naturally, the existing labor rates were increased exorbitantly. So is there any chance to get the additional or escalation for the extended time of completion?
Okay, so there was a lot of discussion about this, and the the clause is pretty clear that it's only extension of time that is provided. But FIDC, I think they went out and they issued a guidance or a guideline to everybody, to rather all the employers, that in the interest of commercial relationships and the fact that one party cannot fully bear the expenses, at the employer's discretion, they have suggested that the employer should also contribute a little bit towards all these matters. Of course, there are contractors also who have made a claim in slightly different way to say that the rate of progress has been impacted because of this, and therefore they are entitled to time and cost. Yeah, so there is a very how do I say, it has only evolved over time and it is still emerging, but at least in the sector that I work in, which is corporate real estate, most employers have been willing to share a load of the cost associated with it.
Okay, thank you, Bosco.
Thank you all for the session. It was a very interesting one, and if time permits, we will again plan for one. But this was a general concept, but a very interesting session. Thank you, Bosco, and special thanks to Joseph for coordinating and bringing a very good speaker to the participants. And thank you all. We will all keep in touch, and our next session will come after 2 weeks. And thank you, Chairman, for joining us today. Thank you all. Bye. Stay safe.
Thank you.
Thank you all.